because all of us, we know that triple bottom line where profit is not the only thing, other factors are also important. Therefore, companies are going beyond profit, think beyond profit. And they have realized that what is important is ensuring adequate fund availability is one thing, and growth maximization and maximization of operating profit before interest and tax, and maximization of return on investment. In recent time, more companies are focusing on shareholder value and shareholder value creation. I mean, so there are two methods: economic value added and market value added. EVA, economic value added, is a measure which goes beyond rate of return. It considers cost of capital also. And Dr. Rajesh is going to deliberate upon all this. And important value drivers of economic value added is revenue augmentation. Is very important to ensure that. I was talking, profit is not the only thing, but it is very important to augment the revenue. How? To ensure that the market share is expanded. How it can be done to ensure that the product is accepted, the product is infused with continuously on a continuous basis with the innovative features, so that the product is accepted widely, and thereby the market share is enhanced. And cost reduction is very important. Economies of scale. Every rupee saved will add to almost 25 rupees of market capitalization. So this is another important value driver of EVA, and effective utilization of assets, because how the organization uses the asset determines the revenue inflow. Effective utilization of asset is another value driver, and reduction in the cost of capital. Without much ado, I would like to hand over to Dr. Rajesh here. Let me tell you, Dr. Rajesh is one academician whom I always admired and appreciated. He is a very committed teacher. And as I was telling about Dr. Latha in the morning, I find perfect synergy of both the teaching and research in Dr. Rajesh Kumar. Now he is the Dean of Chanakya University. That is a rich testimony to his achievements, to his excellent track record, excellent profile. I'm very happy to have Dr. Rajesh Kumar as the resource person. So welcome, Dr. Rajesh Kumar, and it is over to you. Thank you.
So, thank you, sir. Good afternoon to all the participants. I thank Dr. Shiba for her kind words and introduction, a very good friend of mine for many years. Thank you, Dr. Shiba. And I feel privileged, firstly, to be given opportunity and to be here this afternoon, and to be mentioned some good words by my own teacher, Professor Prabhudev sir. During my post-graduation days, sir was teaching us for a couple of months, but the impression has left on us, and the kind of commitment he has showcased, which we even today follow. He has been a role model for us. Sir, thank you very much for this opportunity, sir.
Thank you, Dr.
Thank you, sir. So, friends, very good afternoon. I understand post-lunch session is very challenging. In fact, my first goal for this session, afternoon session, is to keep you awake. And I'm very, very sure there are a lot of things that can be put into your minds if you can focus upon. And trust me, what we take up this afternoon is a very, very, very exciting topic. And how exciting it is, you will see in just a few more minutes. And it's like blink, you miss. And every word, everything that we discuss has a lot of role to play. So I expect you to actively participate, and trust me, by the end of this, you'll have an excellent takeaway from this session. Let me share the screen, and I request all participants to keep your videos switched off. Even audio, please can say keep it in mute. At the end, we can have a discussion. So till then, it will be ideal that we complete the discussion and then at the end we can take up any clarifications. Okay. I presume the screen is visible. Okay. Let's start with this. It will be good if you read this rather than being read. It's accounting department, and they're now coming up with new rules for accounting. What's the rules? You know, there's something interesting. Do you know what it means when all your financial statements are in red ink? And our great accountant says that it's time to change the printer cartridge. That's a typical today's kid of today, where the knowledge base of their own domain is so minimal, and no surprise. I know figures don't lie. Your job is to make them. This is what used to be typical situation scenario for any corporate, but is it even now? Let's see. You handled the audit so well. We're promoting you from accounts receivable to accounts receivable. This is the promotion. 3 minus 2, we all of know, but the kid is asking, do you want my answer in school math or government math or corporate math, whatever? Okay. Now, these are just a few of things. And trust me, this was the earlier scenario. But friends, today, this is not a possibility for a simple reason. One, how to prepare financial statements. There are very clear standards that are pronounced. So a violation cannot happen. Even if it happens, it is qualified and companies can't make it happen. So, and two, the awareness among the public about these financial statements is very high, and how to read financial statements, there is a clear clarity and knowledge. But that's what I thought so till I interacted with MBA students and some MBA faculty. Well, this is one of the fundamental skill anybody must take away, must have, particularly the postgraduate students in commerce and management and the faculty. Somehow I witnessed the developments, particularly latest developments in this domain. The knowledge is very limited, even among the teaching community. Maybe with whom I've interacted. I'm sure many of you in this gathering should definitely have good knowledge on this. So that's when we thought of having this theme for the workshop, how to read financial statements. And the number of models today we have, amazing. Traditionally, we think of only ratio analysis, etc. But today, the progress that has happened is, we can't even imagine. I'm just demonstrating one paper. Our students had worked, MCOM students of my university, Chanakya University. This is a paper they had worked upon. Friends, last June, all of us knew what happened with Adani Enterprises. Last February, after the Hindenburg report came up, there's a big fall, and Adani Enterprises was the big victim, but at that point of time was made as a big culprit. And Adani Enterprise stocks fell because of the markets fell. What not happened? Now, our students did a very interesting work on this. Adani Enterprises, is it truly a cause of concern? And friends, they applied 4 models. Simple, very interesting 4 models. One is called Danish M-score. Such a beautiful model, simple model. By the end of the session today, I'll share certain material with you which can give you good insight on this. And if you apply this model, we can get to know, is there manipulation in the financial statements of any company? And when our students applied this, they found, no, there's no manipulation. So what was claimed by that report was not the reality. But then there are some concerns in that company. Any company does have. So they applied PONT analysis, which you discussed this morning, and identified what are the causes of concern or what are the concern areas in this company. Then they applied one or another very interesting, excellent model called Altman Z-score. And this Z-score will tell us, in the next 2 years, is there a possibility for this company to liquidate, for this company to close down? And they also applied one more model called Petrovsky F-score. which is a very simple model, which can tell us, should I invest in this company stock or not? Now, these are just some of the models that we have today, which can help us to analyze financial statements and make many decisions, both as an insider, as an outsider as well. Now, one such model, and a brilliant model, excellent model, and as we proceed further, you will get to see next 5 or 10 years, friends, this is the future. I'm not exaggerating. This is the future. And this model is called EVA model, Economic Value Added Model. Friends, I'm opening the annual report of Hindustan Unilever Limited. I'm not in the first page. I'm in page number 86 or 87. Hindustan Unilever Limited. This is the latest financial statement, 2022-23, the latest available. Now, I would like you to see economic value added. And for last 10 years, 2013-14 till 22-23, the EVA of this company. Now, what I want to tell you is, this is something which companies recent past has been consciously publishing in the annual report. And definitely it is a very big purpose, very, very big purpose. So what is this EVA all about? Let's see. And how can it help? Both as an insider, outsider, let's see. And let's remember, this is one metric, which can be helpful both for insiders in the company to know what are the problem areas, what to do, what not to do, and even for outsiders, maybe as an investor, as a lender, as a customer, competitor. For anybody, this is one common metric. And we don't have many such common metrics. Any metric that we have is either available for useful for insiders or outsiders. But this is one metric across. It will be helpful. All of us know about Ashwath Damodaran. I mean, being accounting and finance faculty, I'm sure this is one person who will definitely be following, Ashwath Damodaran. Among his many books, one book is Investment Fables. Very interesting book. He has taken what he considers myths in stock markets and disproved these are myths, these are not the reality. Now, one such work he has done in that book is, are good company stocks good for investment? I repeat, are good company stocks good for investment? Companies may be good, but investing in that stocks of that company, is it really good? But then, how to establish is a company good first of all? After establishing is a company good, then this comes into picture, is the stock of that company good to invest or not? And mind you friends, the metric he has used is EVA. So just to give an example of how EVA is important for anything. So if it's a business, if it's a company, presently everything about the company revolves around EVA. Let's see, what is this EVA, economic value added? I'll take it in pockets. First, let us get the understanding of what is EVA, how it is calculated, what it means, and then how it is relevant. And if you remember one more topic I have for today, analyzing cash flow statements. What's the connection between this and how to read cash flow statements? Most of us know how to prepare it, but how to read? Let us see. So the topic for discussion today is what is called the EVA model. Friends, as the name itself says, economic value added. Now, first, let me show you how to calculate it before telling you the meaning, because what I show you itself will tell you what's the meaning of this EVA. Let's experience the meaning rather than just understanding the definition as such. So I'm again taking you to the annual report of EVA, Hindustan Unilever Limited. And please notice how they calculate EVA. Friends, this is EVA. Net operating profits after taxes minus cost of capital employed. Something called NOPAT minus cost of capital employed. And what is this cost of capital employed? Weighted average cost of capital into average capital employed. So to put in simple words, this EVA is something called NOPAT minus WACC into capital employed. This is how it is calculated. Let's begin with this basic requirement, and please ensure every term in this is clear so that you'll understand the utility, application, and its interpretation. Now, what is this NOPAT? Capital employed, where to get it from? How to find WACC? We know, but let me demonstrate. And for this, let me take one simple illustration. Friends, I'm showing you financial statements of a company for a given period. So this is a balance sheet. It has share capital of equity share capital of 500 lakhs, crores, whatever. Other equity, we know, reserves and surplus of 200 crores. 10% debt borrowing 300 crores. Let's say 1,000 crores is the liabilities, long-term liabilities. Sundry assets, 1,000 crores. So the focus is on liabilities. I've also given here income statement. Operating revenues, we know what it means. And this morning you had a session, orientation to financial statements. So you're familiar with these terms. Less operating cost, you get EBIT, the operating profits. Less interest, you get earnings before tax. Less tax, suppose, just take it as 30%, we get earnings after tax. So we have some figures here readily. And I've also given one more item, cost of equity. And I'm sure all of us know the meaning of cost of equity, rate of return expected by equity shareholders. I repeat, cost of equity means rate of return expected by equity shareholders on their funds in the business. Right. Now, very quickly, we'll take just not more than 5 minutes to see how to calculate this EVA first, which is what is readily available in the annual reports. And I'm just showing you annual report of HUL, but by and large today, many Indian companies are providing this, and take any Western company, you will definitely find this. Now, what was the formula for EVA? I'm just putting it here again. EVA is NOPAT minus WACC into capital. Friends, what is this NOPAT? NOPAT, as the name itself says, net operating profits after taxes. Net operating profits after taxes. How to find this? Very simple. We have operating profits available here, EBIT 300. I begin with that. EBIT 300. How we get this? We know. Now, normally in income statement from EBIT, we deduct interest and then we deduct tax. But as you see here, it is operating profits after tax. So it's not profits after tax, operating profits after tax. So how do we get this? Very simple. So calculate tax on operating profits. In this case, since it is 30%, I'm taking 30% of this. So 90 is operating profits, tax. So 210 is operating profits after tax, which is what we call NOPAT, net operating profits after tax. Now, this is the first item. Now, how to get this is not a difficulty. In reality, none of these need to be calculated. All this information is readily available in the annual reports, financial statements, databases. You go to any corporate database, NOPAT is a ready information available. But we understand the meaning, very simple, very straight. 2, capital employed. That is another term we need to calculate EVA. And that is clearly evident here. Capital employed always means the long-term capital. Long-term capital in the balance sheet, as you know, comes under equity and non-current liabilities. So here, equity comprises of equity share capital, other equity, 700 lakhs, and debt, long-term debt, 300 lakhs. So altogether, this, so I will directly put here. So all these three, just take this. So this is capital employed, equity, and non-current liabilities, long-term borrowings. Now, what's the third component we need to calculate this EVA? Number 3, very important, very interesting. WACC, that is weighted average cost of capital. Weighted average cost of capital. Hence, it's also called as overall cost of capital. Overall cost of capital. So on the whole, and again, I said cost of equity is rate of return expected by equity shareholders. Cost of capital is rate of return expected by all those who have funded the business. All those who are funded, let it be owners, lenders, anybody, all of those who have contributed funds to business. On the whole, what is the rate of return? On an average, what's the rate of return they're expecting? That is WACC. Now, how to find this? I'm sure all of you definitely have an idea on this. So K is how we denote WACC. It is calculated by KDWD plus KEW. Cost of debt into weight of debt plus cost of equity into weight of equity. I'm sure this is a very common knowledge and something very fundamental. But for the given information, first let us see how to calculate this. Friends, KD, cost of debt, is rate of interest into 1 minus T. We know the interest that we pay on debt has a tax benefit. So whatever the return we give is not the cost to the company. The tax benefit on that should be adjusted to get the cost. So what is the rate of interest? The debt here is 10%. Tax rate is 30%. So it is 10 into 1 minus 0.3. So 10 into 1 minus 0.3. 7% is cost of debt. Effective cost of debt. Weight of debt. Now, out of 1,000 lakhs or crores, there's a total capital employed. Debt is 300. So what is the proportion? 300 by 1,000, 0.3. There's a weight proportion of debt in the total funding, total capital. Cost of equity, again repeat the meaning. Rate of return expected by equity shareholders. What are the funds, their funds in the business? On that, what is the rate of return they're expecting? And this is readily given, 20%. But how to obtain this? In reality, how to calculate this? So the best model that is always in use is CAPM. Friends, I'm again showing you the annual report of HUL, where they shown how to calculate EVA. And please see this statement, cost of equity. Risk-free return equivalent to yield on long-term government bonds, RF we call it, plus market risk premium, we call RP or RM minus RF into beta. I'm sure most of you have recognized that this is CAPM model for calculating cost of equity. Those who are not aware, later, those interested, I'll send some of my recorded videos, YouTube videos available for you to get a knowledge on this. How to calculate or demonstrate it, you can completely watch them. How to use CAPM model and calculate cost of equity for any company. You can do it yourself once you get that idea. But I'm sure being finance faculty, you definitely have that idea with you. So this is a model, but I've readily given here. Weight of equity, we know, out of 1,000 lakhs or crores, 700 is shareholders funds, equity shareholders funds, including share capital and other equity. So 0.7. Now let us calculate WACC. K, it is KD into WD plus KE into WE. So 16.1% is WACC. So on the total funds mobilized by the company, this is the rate of return the company is giving, which is nothing but rate of return expected by those who have funded the business. Right? Friends, to calculate this EVA, we need 3 components, NOPAT, WACC, capital employed. Now, all these 3 are available. As I said, we don't have to even actually make these calculations. It's readily available. Again, can you see the annual report of HUL? Equity, cost of debt post-tax, R into 1 minus T. Cost of equity, how it's calculated, I showed you. They use CAPM. WACC, all these are available. NOPAT, HUL, they directly show the calculation. But by and large, any company annual report, friends, do provide this. Okay. So now we have all the components ready to calculate EVA. Let us calculate EVA, NOPAT, friends, is 210 NOPAT minus WACC 16.1% into capital employed. I'm using Excel functions to show some effects as we go further and show the calculations. But NOPAT 210 minus WACC into capital employed is EVA. So we got a number 49, some number. Now, friends, what I've shown you is how to calculate EVA. What's the meaning of it? What's the relevant significance of it? Let's see now. So, EVA, a very, very powerful, trust me, a very powerful metric to meet all requirements for any analysis, interpretation, and situations. How to calculate is all that I demonstrated, which, as I said, you don't need to even calculate, it's readily available. So, HUL, I showed you, as given for last 10 years, what is the EVA? But what is this EVA actually? Let's see. Friends, let's take up this income statement. How an income statement is prepared, we know. What are given here is abridged summary. At the end of income statement, we have profits after tax, earnings after tax, net profits, bottom line. Now, we all know it belongs to whom? Equity shareholders, profits after tax. In case we have preference shares, and I'm sure all of us know, very, very few companies in India has preference shares in its capital structure. In case we have preference share dividend, we get what is called net income, which is profits available to equity shareholders. Now, here we don't have, so these are profits available to equity shareholders. Friends, let's again recollect. What is cost of equity? Rate of return expected by equity shareholders. What are their funds are used in business on the rate of return expected. Now, how much is the shareholders funds we have here in the business? Equity shareholders funds, share capital of 500, other equity comprising of reserves and surplus 700. This is the shareholders funds in business, which is used in business. So their funds invested in business. Now, on that, what's the rate of return they're expecting? 20%. So friends, I take 20% of 700, which is the shareholders funds. So this is the returns shareholders are expecting. These are profits company has made, which is available to shareholders. And please see, this is what's available. This is what is expected. What's the difference? 49. Is this number familiar? Yes. That's exactly what we got as EVA. So, what is EVA? What we calculate, there's a purpose. Now, PAT minus WCC, there's a purpose. And there's a model created by a company, I'll tell you. But exact same number I got in a very simple, easy manner. What was all that I did was from profits available to shareholders minus profits expected by shareholders, I got the same number. And this number is properly called as residual income, residual profits. Friends, this is EVA. Profits generated by the company, profits made by the company over and above shareholders' expectations. Was the profits company has made, company has earned over and above the equity shareholders' expectation. That is what we call as EVA. Simple. So here, in this case, was excess profits company has earned over and above what is expected by equity shareholders? 49 lakhs. What? Great. So EVA, it's called residual income. That is a concept. Residual income is a very well-known concept from ages. But why are we calling it as EVA then? I'll tell you in a couple of minutes. But before that, friends, in this scenario, what I explained, we saw what is EVA. EVA is 49. And what is this? Company is earning 49 lakhs or crores over and above shareholders' expectations. Now, I'll make a small change in this income statement. Please note, I've taken revenues as 800. Suppose instead of 800, it is 600. Suppose some number. Now, please see, still we have profits, 49. Company is making profits. But friends, no PAT. 100 lakh is EBIT, 30% tax, 70 is no PAT. Capital employed 1000. WSS is 16.1%. But friends, EVA negative, minus 91, which you can see here as well. What is it? Company has made profits, no doubt. It has made profits. It's a profit-making company, but not making profits sufficient to meet shareholders' expectations. It has fallen short of shareholders' expectations. Now, friends, in case company has made profits, if it is loss-making, it's a different story. Yeah, we know it's loss-making. But even companies which make profit may not meet expectation of shareholders. So the deficit in this case, minus 91 lakhs deficit is called EVE. We know what is EVA, economic value added. What is EVE? Economic value eroded. It's the value erosion that has happened of shareholders. So EVA goes beyond profits, as sir was mentioning. Profit is just a simple metric, and you know very well, profit is never used for any critic, any concern. We use EBITDA, use EBIT. Net profit is never useful for any requirement, any decision making. So profit is one part, but EVA goes beyond profits, and it says, is there a value addition by the company to shareholders, or is the company eroding the value of shareholders? Now, when does a company add value to shareholders? When it is generating profits over and above shareholders' expectations, then it is EVA. But where company makes profits but is not meeting expectation of shareholders, making profits, mind you, but still it is not adding value, rather it is eroding the value of shareholders. And this is what we call as EVE. So negative EVA is EVE. But we don't use EVE as a term. It's always EVA, maybe positive or negative. Now, firstly, HUL. Can you please see what has happened in the last 10 years? 2013 onwards, can you see a steady increase? What is EVA? Profits earned over and above shareholders' expectation. And just think, if my company is giving me profits over and above my expectation, next year, what I expect will be much higher, right? So if company is giving profit, if company is earning profits more than what I expect, next year I expect more than that. But can you see, whatever is the expectation of shareholders, it's earning much more than that, and every year it is increasing. So it's not just meeting shareholders' expectation, meeting increased expectation of shareholders. Every year, definitely expectation, because last year, when I got more, when the company made more profits than what I expected, this year my expectation will increase, and companies managed to make even higher profits. Now, consistently it has been rising, but 1920, we know 2021 what happened, COVID, the effects. So there was a fall, of course, understandable, but despite that, there was EVA, still there was a validation, just that there was a little lower amount of validation. Even then, don't forget, company has made profit over and above shareholders' expectation. Just it is compared to earlier year, it was not comparable. But again, after that, if you can again see, it is increasing. Excellent. Now, this is concept of EVA. Now, why do you think company should give this in the annual report first of all? And why are we so much emphasizing that EVA is great, important? It is, trust me, important. And I'll show you some research papers on this, very exciting research work. One of my student herself did a research, her MPhil was on a topic on this, which I'll show the paper later, and wonderful work and lot of research scope that is available. And I would still say, though early 90s, this concept started, India was still in nascent stage. So the earlier we are ready, geared up to adopt this, apply, and train our students, friends, we are the pioneers in many things. Now, how is it so useful? What is the relevance of EVA? I said, as an outsider, as an insider, this will be very helpful. Now, as an outsider, let's say I'm an investor. Looking at this EVA, I'm very happy. Every year, whatever I expect, companies are giving me more profits, earning more profits, and that is increasing every year as well. Excellent. That's good enough for me to think of investing in HUL. So long term, if you're a shareholder of HUL, you really benefit. I'm not talking about trading, I'm talking about investing. But then, is that all the purpose of EVA? No, it's not meant just for shareholders' information. Friends, its ambit is very big, trust me, very big. And how it can be helpful, you can't even imagine. And what a next show will give you very exciting connection, firstly with financial statements, 2, what you discussed this morning, DuPont model, 3, cash flow statement, everything you will see how it gets connected. And this is one unfortunate thing. Many of us don't know the connections between these financial statements. Okay, so this is now before I proceed further, please respond to this. I'm stopping sharing. Firstly, are we clear on the concept of EVA? You can put it in the chat box. And 2, what we have discussed till now, do you have clarity? Please say so, say that. Then I'll ask 1 or 2 questions from which I'll take it through. So, are we clear on the concept of EVA? Yes, great. Thank you. So, what is EVA? Profits earned by the company over and above shareholders' expectations. As a formula, we have something to calculate. That's fair. That's fine. But we know what it is. Great. So, as a shareholder, how it is helpful for us? Okay. Now, please think. If you were to be shareholder of a company, would you like the EVA to increase or decrease? Then put your question and response in the chat box. If you have to be shareholder of a company, now that we have understood what is EVA, so if you have to be shareholder of a company, would you like the EVA of a company to rise or fall, increase or decrease? This is something we discussed all this while. So, as an investor, what would you like to happen? EVA to increase, decrease. Okay, so it should increase. Okay, it's a direct message from one participant. Any case, it can be made available to everyone. So, yeah, it should increase. That's evident, simple common sense. How should a company increase its EVA? How can we make this happen? Let's see. And let's see the next part. And whatever I discuss, I'll share it at the end of the session. Maybe in the chat box itself, I'll share. But a very, very exciting connection. So, I'm sharing the screen again. So, what's the requirement? This is the objective to increase EVA. I would like you to see the arrow marks. So that's what any company should aim at least to begin with, I think only from investor perspective, company should increase its EVA. How to increase it? And this increase, is it only for the benefit of investors? Not at all. That's where I said, we'll see the application part of it. Friends, what's a formula to calculate EVA? NOPAT minus WCC into capital. This is EVA. So very simple, common sense. If I increase EVA, what should I do? Either increase NOPAT or bring down your cost of capital or bring down your capital employed. So if you reduce capital employed or reduce WCC or increase NOPAT or all of this, if you can make happen, then your EVA will increase. So I'll say NOPAT, capital employed, WCC. So either WCC should decrease, capital employed should decrease, or NOPAT should increase. If any of these or all this happen, your EVA will increase and excellent to happen. So please see how EVA helps every dimension of business. Now let's take one by one. Friends, as we take each one, you will see the entire essence of an MBA program. Now, how to increase NOPAT net operating profits after tax. Very simple. Either increase operating revenue, or decrease operating cost, or decrease tax, right? So either increase operating revenue, or decrease operating cost, or decrease tax. I'm sure we can visualize. So if any of these happen, our NOPAT increases. Friends, how to increase our revenues? How can any company increase its revenues? Friends, this is exactly what we discuss in the courses, marketing management, strategic management, etc. That's exactly the focus. So whatever we learn, teach, everything has a purpose, very simple purpose, value addition, value creation. So what does this help us in? In identifying, in making revenues to increase. How to bring down cost, operating cost? And this is another exciting area, cost management. All of us have learned this. I've been learning this. We teach our students, but please realize the practical relevance of it. Highly relevant, practically relevant. Every tool that we have learned, I'm sure all of us know. Marginal costing, standard costing, budgetary control, all these are traditional. Activity-based costing, life cycle costing, target costing, everything that is recent past, purpose is control and reduce cost. And as you do that, what happens? Operating cost reduces. When operating cost reduces, NOPAT increases. When NOPAT increases, EVA increases. But why should EVA increase? To begin with, we're thinking only from shareholder perspective. As an investor, I definitely would love to see my company making more and more profits than what I expect. And this cost management, unfortunately, is just a subject, a few topics at even any PG level, which is more discussed from exam perspective. But please take my word, it has such a practical relevance. How equipped our students are in this, so great opportunities. Just to very quickly give one of my experience. We were doing a training program for a company called Godrej Agrovet. This company is the one which makes real good chicken. Their office was in Old Airport Road behind Manipal Hospital. They wanted us to do a training program on an exclusive topic called marginal costing. Friends, marginal costing. Simple. This was a 1-week program, evening 6 to 9. Mornings they used to finish the work, evening they started in their own campus. And I was the lead faculty. I did this program for them, and participants were from managing director till office boy, who was a graduate himself, but his designation was an office boy. All of them participated in this. Monday to Friday, we ran this program. Friday, when we gave them an assignment for last day. In their own domain, whatever they're responsible for, they should demonstrate how they can use marginal costing for decision making. That was a simple assignment. They all came prepared. Next day, presentations were made. The managing director gave a beautiful scenario. They were contemplating to start a new plant, a new factory in Oscote. So how we will use marginal costing to decide should we start or not. He demonstrated. Very interesting. Like that, everyone demonstrated. But the best of it was the office boy. Once he demonstrated so beautifully, when you need to take any copies of any document, will you take a printout or will you take a photocopy? How to make the decision using marginal costing, you demonstrated. Think how in-depth we can use this technique. And what's the purpose of any of those techniques? To reduce operating cost. And what can happen? NOPAT increases, EVA increases. Now, how else can we increase NOPAT? Another way is to bring down tax. Now, tax is a burden. It's a compulsory payment. How can we bring? Friends, definitely there are possibilities through what is called tax planning and management. This is another course finance faculty teach students, tax planning and management. It's not just course again for exams. It has a lot of practical elements. We have consulted many of our clients on only from tax perspective, what all they can do to increase profits. Minute things. How they can effectively take advantage of or take benefit of all the various tax provisions and benefits extended by Tax Act. What they should do, what they should not as far as tax is concerned. Simple things, but has a big role to play. Now, these are three bodies of knowledge, which, if you can recognize, is what we discuss with our students, what we teach, but hope you now realize the purpose of this. Now, how to increase EVA? If increase in EVA is what we need, how to increase it? One, either increase NOPAT. How to make that happen? So either by increasing revenue or bringing down cost, bringing down tax. Another way is to bring down capital employed. Now, how to bring down capital employed? Very simple. This capital is employed in what? Invested in what? In non-current assets, current assets. I'll just use the traditional term, fixed assets, current assets. Friends, if this is used efficiently, if we use our assets efficiently, the need for reinvestment is less. So the need for additional capital is less. So capital employed will be less or status quo. So how we manage our assets will also help us to increase EVA and fixed assets. How to manage it? Friends, we have capital budgeting, but more importantly, the course called project management. Whatever we learn there is how to keep capital expenditure in control, how to optimally have an optimal benefit of capital expenditure, nothing but fixed assets. Again, please realize the purpose of this course. How to manage current assets? This is what we learn in working capital management. And this is something I feel always bad about at any level, including PG level. Working capital management is just a topic of discussion in some subject, but this itself needs exclusive discussion. There are programs, exclusive working capital management, but the depth is very huge and the purpose need of this is very, very big. Any company which either is made or broken is because of working capital management. So can make or break a company by effectively or ineffectively managing the working capital. And all of us, I'm sure, know how important it is. Every component, receivables management, cash management, inventory management, every component in that. So this is how we manage. And if we can make this happen, manage assets effectively, efficiently, your need to reinvest is less. That is, your capital employed will be less. And if capital employed comes down, your EVA increases. What's another component that we have? WACC, weighted average cost of capital. Again, even if this is brought down, you can increase the value. You can provide more value to the shareholders. How to increase this or how to decrease this? Sorry. So identifying what are the appropriate sources of funding for that business. For every business, all the sources are not helpful. So you would know what are the factors influencing capital structure decisions. So from which sources are applicable to which industry, which business. And more importantly, how to reduce, how to bring down what is called specific cost of each. So how to bring down cost of debt, how to bring down cost of equity, how to bring down cost of preference. And there are tools and techniques for each of this. So we know we have a course called corporate restructuring. In that, you come across a topic called financial restructuring. They will learn all the tools and techniques which help us in this. So how to know which are appropriate sources at this point of time, how to bring down cost. So friends, for this, we need to learn financial systems and corporate restructuring. So those of you who are finance faculty can recognize all these are various courses that we have already. So just connecting them and giving them a logical end, taking to the logical order, how much complete our knowledge will be, our students' knowledge will be. So these domains help us to understand how to bring down WACC. That's something very exciting. Friends, EVA can be increased, firstly, by increasing NOPAT, which includes increasing operating revenue or decreasing cost or decreasing tax. Friends, where do we find all these items? The operating revenue, operating cost, everything, income statement. So the first requirement is to know how to manage all our items in income statement. And if this can be done, is it only the outside shareholders are benefited? Absolutely not. Entire company is benefited from inside. So the PAT can be increased. How? These are the items. All this, where do you find? Income statement. Now, fixed assets, current assets. Where do you find them? Asset side of the balance sheet. And sources. Where do we locate them? Liability side. So can you see both major financial statements, income statement, balance sheet is captured. So can you see how EVA actually is depicting, is summarizing entire both two financial statements, income statement and balance sheet. You see the connection? So that EVA, what we see, is not just some independent figure. It is something which connects income statement and balance sheet. Now, what is interesting is the next part. Friends, I want to increase NOPAT. So I know if I manage items in income statement, I can manage to increase NOPAT. Now, what items to manage? Does all items in income statement call for attention? Definitely not. What is of concern? If you can identify and manage it at the right time with the right strategy, my purpose is served. How to identify which items in income statement is a concern? Friends, there is a metric to measure income statement called profitability. This is a metric which we use to measure for income statement. For assets, there's a metric called efficiency. And for liabilities, there is a metric called risk. How to use this metric? Friends, you learned it this morning. You know, profitability into efficiency into risk. This morning you learned return on equity. And which is this model we're discussing? DuPont model. I can give you thousands of examples of how we have used DuPont model to solve many problems of many concerns of many companies. Can quote examples of our students who have done projects using DuPont and come up with problems and solutions for companies. Trust me. So please see the connection back. ROE, if you decompose ROE, it can be decomposed into profitability, efficiency, risk. How to measure profitability? I'm sure this morning we will see PAT by shareholders funds, efficiency, turnover by total assets, risk, total assets by shareholders funds. So when you multiply all this, we get ROE, or ROE is decomposed into this. And if I further decompose profitability, further you can identify which items in income statement as a concern, which items need attention. To decompose efficiency, you get to know which items, balance sheet, particularly which current assets as a concern, which needs to be addressed. If you decompose risk, there's nothing to decomposition, but risk is something which you can increase or decrease by restructuring, financial restructuring. There's a risk high or low, you can identify. So please see the connection between what you learned this morning, DuPont and EVA. All these are brilliant models. DuPont is 103-year-old model. EVA 1990. This was proposed by, today it is patented for this company called Stern and Stewart. So the residual income concept, they convert into a model, and why this model is required. Though calculating, we could have easily calculated. Residual income was easy method to calculate. But what's the need, friends? Through this model, Stern and Stewart are providing us what is called value drivers. What drives value? So to see the values driven, what should be managed? That's why this EVA model is called VBA model, value-based management model, a model which helps to create value, enhance value, maximize value. But there's even thing which is even more exciting. Friends. So firstly, recognize the connection between EVA and ROE. Please see. So if ROE is increasing, it also means indirectly EVA is increasing. ROE is falling, EVA is falling. So you know how powerful metric is ROE. We just take it as a ratio. But ROE has a very big role to play in a lot of things. And now we know what it else indicates. ROE is not just the return, it is also a proxy for value creation. So an increase in ROE means there's increase in value. It's adding, companies adding value. If there's a fall in ROE, it means there is a decline in value or value erosion that is happening. So indirectly we could say, and this is the connection, what I'm showing. But what is even more interesting? Friends, suppose we apply DuPont model, identify in income statement which are the concern areas, take care of it. With a lot of tools, strategies, techniques. How effectively has company managed these items? Which items? Items in income statement, items under assets, items under liabilities. How effectively has a company managed it? How to know? Let's see. Friends, this item income statement, which relates to what? Our operations. We can also call it as operating activities. Operating activities. Operating activities. So all items relating to income statement are operating activities. Those relating to assets, I'm sure we know, investing activities, and those relating to liabilities are called financing activities. Now, I'm sure you're able to recognize where we come across all these terms. Friends, all these are terms we find where in statement of cash flows. Let's see how EVA one helps us to identify that. Even DuPont for that matter. What to manage and how well it is managed. So even DuPont and EVA both, the end point is cash flow statement. I'm sure all of us know cash flow statement is a mandatory statement to be provided by every company. Annual report, you will find it. Why is it mandatory? What's the purpose? We train all our students on how to prepare cash flow statement. Brilliant, wonderful, excellent. How many of us teach them how to read it? Hardly. In fact, unfortunately, many of us don't know how to read cash flow statement. And whenever asked, what does cash flow statement tell? It says, it tells from where the company has got cash, from where it, or what it has spent cash. What's the use of it? Correct. It tells that. But how does it help me? It's of no use. So to read a cash flow statement, let's see. But what we recognize is how EVA connects the financial statements, income statement, balance sheet, and the statement of cash flows, which is a mandatory statement. In India, it was made mandatory 15 years back. But US Western companies, it was much before. And the trigger for that was this EVA. Now, quickly, let's see how to read cash flow statement. Please note this. Now, what you see in the screen is a typical format of a statement of cash flows. Typically, you see opening and closing balance difference given, increase or decrease in cash or cash equivalent. But essentially, you have this net cash flow from operating activity, net cash flow from investing activity, net cash flow from financing activity. So if I to show of HUL also again. The corporate governance report, we get this financial statements. financial statements. So we know it is mandatory. And what are the items under this? All of us are familiar by now. Just 1 more minute. This consolidated, whichever. So cash flow from operating activity, you can see here, net cash flow from investing activities, net cash flow from financing, then the difference, increase or decrease in cash and cash equivalent, that is closing minus opening, whatever. Now, what is these items? Opening balance, closing balance of cash and cash equivalent, we know. Cash in and cash in bank and all the cash equivalent in the company as at the beginning of their end of the year. But what is this net cash flow from operating, investing, financing activity? Friends, net cash flow means difference between inflows and outflows. Inflows minus outflows. That is net cash flow. Now, quickly, let us think. When I say net cash flow from operating activities, what does it mean? Cash inflows from operating activity, outflows for operating activity. The difference is net. Now, what are the inflows from operating activity? Sales, revenue from operations, sales. So, when I say inflow from operating activity, nothing but sales revenue. Outflows, nothing but operating cost. So, operating revenue, operating cost is inflow, outflow from operating activity. So, net cash flow, difference between these is nothing but, if it is plus, what is profit? If it is difference is plus, it means from operating activity, company is making profits. If net cash flow from operating activities minus, it means from operating activities, company is incurring losses. So, inflow from operating activities, revenue from operations, outflows is operating cost, difference represent either profit or loss. So, net cash flow plus indicates profit from operating activity, minus indicates loss from operating activity. That is first item, keep in mind. Now, investing activity. Investments in where? Assets. Outflows means what? Purchase of assets. So, outflows for investing is nothing but investing in assets of the company in the purchase of assets. Now, inflows is nothing but assets sold, sale of assets. So when you take net amount, if the net is minus, what does it indicate? Company has invested more in fixed asset this year than what it has sold. Company has invested more amount in fixed asset than what it has sold. If cash flow from investing activities plus, what does it mean? Company has sold assets more than what it has invested in this year. That is net cash flow from investing activity. Finally, what is this net cash flow from financing activities? Inflows represent amount raised by issue of shares, loans borrowed, etc. Outflows towards financing activity mean interest paid, dividend paid, loan repaid, debenture redemption, preferential redemption, buyback of shares. All this is outflow. Net, when we take, plus indicates company has mobilized, got more funds this year. Minus indicates company has repaid its obligations, met its obligation of interest payment, dividend payment, and repaid its loans, etc. If it is net, it is minus. Now, why am I insisting on plus minus, friends? And this is all that we need to read a cash flow statement. We don't have to see the numbers. Numbers are there to prepare it. Reading is just with the help of symbols, signs. So if you see here, for operating activity, HUL, Hindustan Unilever, net cash flow from operating for 2022-23, number 9991 is of no relevance for us. All that we need is it plus or minus? Friends, the net cash flow from operating activity is plus. For HUL, this is plus. Now, investing activities, if you notice, cash flow from investing activities, net cash flow for investing, if you notice, 1494 in brackets means it is minus. So that's all we need to know. It is minus. And financing activity, if you take for HUL, net cash flow financing, if you see, again, minus. Now, this is for HUL. Friends, take my word, this is more than enough. What does this mean? How to read it? Friends, net cash flow from operating activity plus other two minus means company is making profit from its operations. Company is making profit out of its operations, using which it is investing in assets and meeting its financial obligations. Company is making profit from its operations, out of which it is investing its assets and meeting its financial obligations. Is it good? Excellent, the best. And consistently, this is what any company has, friends. We call such company as value-adding companies. Value-adding companies. Value-creating companies. Consistently for a few years. And this is exactly what we should look at. As a shareholder, is of very big use to. Now, I don't want to open annual reports and search for cash flow statements, but a big list of annual reports with me here. Each of it, when I share it with you, can take a look, but I'll give this scenarios now. You can see. Well, suppose net cash flow from operating activities is minus, net cash flow from investing activities is plus, and net cash flow from financing activities is also plus. What does it mean? It means company is incurring loss from its operations, which it is making up by selling assets and borrowing funds. I repeat, company is incurring loss on its operations, which it is making up by selling its assets and borrowing funds. Is it good? Worst scenario to happen. Such companies are called what we call as, friends, value eroding companies. Value eroding companies. Please see, just looking at cash flow statement symbols, you can write stories. Now, please take a look later. Adani, Reliance. Please take a look later. Friends, this is how we find this. Plus, minus, plus. This is how you find Adani, Reliance, and many companies. What is this? Company is making profits, borrowing funds, and both these it is investing in assets. So, internally generated profits, funds from outside, together diverted towards investment. And such companies are what we call as growth companies. Growth companies. Excellent. Reliance, good. Adani Enterprises, you saw last 3 days, 31% increase in stock price. So growth companies. Now, what I'm trying to show you is how cash flow statement can be read and how much you can infer out of it. Now, where did I get this, friends? This is a must read for every management faculty, particularly finance faculty. There's a book titled Business Valuation and Analysis Using Financial Statements. This is by Krishna Palepu and others. Krishna Palepu and others. So, please read this book. Recent editions are available. As you can see, the title itself, how exciting. Business Valuation and Analysis Using Financial Statements. And if you notice, everything, whatever we're discussing today is around financial statements. How to teach, we are discussing, but how to use this, we are not. Now, this is where these books will be helpful for us. Let's take it through. So this is cash flow statement. And I want you to notice the connection between EVA, financial statements, particular cash flow statement, including DuPont cash flow statement. Friends, all these models firstly tell us what to manage, and then through cash flow statement shows us how well it has been managed. So this DuPont model, EVA model provide what is called value drivers. What drive value? So what need to be managed, etc. Let's see how helpful. And I tell you from my experience, all these we have used. Trained companies, many cases we have actually identified their problems, concerns, and addressed them as well. Practically, all these are relevant. And imagine a student going to the company with this background, where they stand. Now, friends, where all can we apply EVA? EVA is not just a number calculator. Friends, EVA is a model. Now, where all can you use this? Literally everywhere, every single decision a company needs to make, friends, today you can make with EVA. All the tools and techniques, whatever we have been using all this while, can be replaced with one metric called EVA, friends. So, for example, corporate valuation. All this, well, which is the best method we think of? DCF method. The best, excellent. Now, try doing it using EVA method. Exact to the dot, you get same value. Exact, same value. So, which means the most popular DCF method can be replaced. I'll show many such research articles. So, performance measurement, HR related, performance and compensation management. I'll put it in the same language. Performance management, compensation management, every aspect relating to HR. You can make decisions with the help of this. I'll show you some cases which I have. Then, wherever you need for cost management, you can. Marketing strategies, marketing decisions, you can. How? There are cases available. I'll show you. As a shareholder, which stock to buy, which not to buy, I can decide. Capital budgeting, all of us have been teaching this. The best method for capital budgeting till now is NPV method, correct? Friends, you can make the same capital budgeting decision using EVA, and please calculate the EVA, what it will exactly be the same as NPV. You can replace NPV with EVA. Just listed just a few applications. Literally every domain, everywhere where a business has to make decision, you can use EVA today. Please see what I'm showing you. So this is some research, just a few which I'm showing you. I'll share all these by the end of the day. Please go through. This is a very beautiful article which introduces the concept of EVA, a rich concept of wealth creation beyond profit maximization and adding value. It's exactly what Prabhudev sir was telling us. According to this, all this is from the top journals, announcing the Stern Stewart Performance 1000, a new way of viewing corporate America. And friends, it's in 1990, the time it was introduced. First time it was introduced, the new way to look at corporate America made a big sense. And from there on, you can see every American company by and large following the same. Bringing strategy back into financial systems of performance measurement. Bringing strategy into financial systems of performance measurement. See the connections. Integrating EVA and process-based costing, PBC. What I'm showing is just a few which we can emulate. Then, evaluating relationship between EVA and stock returns in company, a very popular study. This is another very interesting study. Evidence of EVA. So how EVA have been helpful in addressing problems of the company, a very beautiful article. Practically, all this is implemented. It's not like any imaginary research, as some of our friends do. What has been carried out? How to use EVA in oil and gas industry. Industry-wise, we have studies that has been conducted. Identifying value creators. All this while we are telling you, value drivers, value creators. So both DuPont model, and this is a case basically, and EVA, whatever we have learned both today are actually what helps us to identify value drivers, value creators. This is what I said is a study conducted by my student. Impact of value metrics on stock prices, a sector-wise study. Pushpa was her name. She is a very senior finance faculty today at Christ University, doing a very good job. This study, and one of the metrics she has used is EVA, and she has found, compared to another metric, the impact of EVA on stock price is higher. Like this, we have a big list, and there are very interesting cases available which can help you to better understand what is this EVA. So TTK Prestige, our own company, EVA. So it's a case, and simple case which you can take to classroom and discuss with our students, but the enrichment they can get is very high. I can share it along with the teaching note. And this is one more case called Viodome Pharmaceuticals. Very, very brilliant case, super case. It takes around 3 to 4 hours whenever I discuss for MBA. And this case is very, very simple. Friends, at the end of this case, there is a table with 2 blanks. This entire case is about just filling these 2 numbers. That's it. Just identifying the 2 numbers. That 3 to 4 hours it will take. But by the end of it, you have a complete, thorough understanding of what EVA is all about, how it can be used in application, for what all it could be used, etc. In that case, they've used it for performance measurement. So like this, we have good number of cases available, research articles available, which I'll share it with you. And I don't have that paper here. I mentioned about one research carried out by Ashwath Damodaran. Are good company stocks good for investment? We emulated the same for Indian companies, myself and same Dr. Pushpa, whom I showed. We're working on the paper. It will be finalized shortly. And here again, we have done the same. Based on EVA, we identified which companies are good. That's the best metric. But does good company mean investing in stock of that company is good? Not necessarily. So we're trying to come up with that. Company being good, stock being good is not the same. So what are the metrics and parameters? Now, this is a brief of this concept called EVA. And what I want to recognize is how it is relevant practically and how it connects all the financial statements and how it leads to cash flow statement, how to read cash flow statements. And as I said, the application areas, mind difference, really very, very helpful. And if you can read on this, lot of research potential, firstly. 2, you'll be very close. You'll have definitely a lot more practical knowledge, which industry expects. We can pass it on to students. And this is one thing through which can definitely take up some consulting opportunities, for sure. Friends, I will share all the material with the organizers. But for those of you who need to interact with me, who need the material exclusively, please feel free to mail me to this ID student@drvrk.in or vrkumar27@gmail.com. One of these you mail me. I'll send the material. Also, anything else which I can be of assistance for any of your topics, I'll be most happy to. Research is my passion, but research in finance. So anything I can be of assistance, I definitely would love to be part of it. So thanks the organizers. Prabhudev sir, thank you so much, sir. Yeah. And Dr. Shiba. First, we can open up for questions and then we can take it further. So I'm open for questions now.
You can either ask questions on chat or if you want to ask without just on chat, you can just switch on your raise your hand so that we can switch on your video and audio and you can ask questions.
So one of 2 things should have been possible, sir. Either It has been clearly well understood, so no doubts. Or nothing is understood, so no doubts. One of these should have happened, sir.
The first one is true, in fact, the hallmark of a good teacher is his ability to engage the participants. 90 minutes have gone by and there is not even a single dull moment. Dr. Rajesh Kumar has done an excellent job today. And I consider today is a very important day because having two of my academic friends, Dr. Lata Ramesh, my former colleague at Christ University, and Dr. Rajesh Kumar, my former student. I'm very proud of Dr. Rajesh Kumar for his wonderful ability to hold the audience captive through his inimicable style, loaded with examples, loaded with beautiful explanation, beautiful narratives. And here, Dr. Rajesh made use of annual report of companies. I strongly believe that all the faculty, finance faculty, should make best use of annual report. That is where you pick up a lot of valuable inputs and link it with the classroom learning, classroom teaching to create, to foster a good learning excitement in the class. Because what happens, if you go to the class only with the book content, that is one thing. But to make the learning more interesting, more engaging, and more gratifying, I think we should make extensive use of annual report. And of late, companies are giving a lot of importance to annual report. They ensure that the information, the content of the annual report is beyond the statutory requirement, and it is more informative, more exhaustive, more analytical, and it is a treat for researcher, especially finance researcher and finance faculty, to use the content of the annual report. And Dr. Rajesh has done an excellent job, in my opinion. As a teacher myself, he has got the ability to make it very interesting, very simple. And simplicity is Dr. Rajesh Kumar hallmark. I really appreciate. And he has brought out many examples. And he was also mentioning Professor Krishna Palepu's book. And incidentally, let me tell you here, Krishna Palepu was the independent director at Satyam Computers. And he was the first one to blow the whistle through sending an email. But what happened was not economic value added. It was economic value eroded eventually. But he was an independent director. He was the first one to blow the whistle. And he will make the whole teaching experience a very exciting and very involving, and by ensuring that all of us will be having a collaborative learning by putting our heads together, by putting our thoughts together. And we should meet like this often to bring more perspective, bring more insight, and make a teaching very, very enjoyable, very, very creative. After all, teaching is more creative. It is a craft. So we should develop the craftsmanship in us to take the teaching to the next level. I compliment all the participants for your wonderful participation. And Dr. Rajesh Kumar was inviting questions, and he made two alternate statements. The first one is very true. He has made it so interesting, so clear that there's no question, absolutely, for anybody to ask. I compliment the participants, and I compliment and thank Dr. Rajesh Kumar for a wonderful presentation, wonderful way of engaging the participants. And thank you, Dr. Sheba. I thank the organizers, my team here, who have done an excellent job. And we are very, very happy with the outcome of this very engaging and very useful faculty development program. And all of us, we will keep connected, and we should meet often to ensure that we add value to our teaching. Economic value added, like value added, academic value added also. Over to Dr. Sheba for other announcement.
Thank you, sir. Thank you, Dr. Rajesh Kumar. Your patience and clarity has silenced us all. I think maybe that's why nobody responded. I just want to thank you. I think I personally learned a lot, though I come from the corporate, and there was a lot of learning because, like what you said, the cash flow statement is often not read well.
Yes.
And I think just you brought it out so clearly, and I think very interesting. And I personally learned a lot. Thank you for the insights that you gave. Though it was post lunch, never felt like sleeping. We couldn't doze off because you kept us on the toes, just explaining it so beautifully. Like we can understand how your students enjoy your class. Thank you so much.
Perhaps you can give your experience. How did you like Dr. Rish?
So firstly, of course, from the time, this was decided upon, I felt, of course, firstly, it was for me, I felt very thrilling to be associated with you and do this program. The way things have been organized from day one, it was good. Participants, of course, they didn't interact much, but then I see some names which are familiar to me. Some names, some of them have interacted earlier already. I'm sure there should have been some takeaway, good takeaways for them as well.
That is huge takeaway. Huge takeaway. Dr. Shiba, now you can say something about.
Yes, I think if they have any, I'm sure they will have more to write to you because you've given your email ID and your number.
Sure.
They could definitely reach out to you because this is more in depth and probably they want more, for a discussion that can go on a little ahead. Okay, just to thank you once again for your time, and I know it's in the midst of what you're doing. You've given us the MQI College of Management the time and your expertise in sharing all that you've learned personally and helping us also to learn. Thank you so much, Dr. Rajesh. I just
I've shared I've shared the Excel sheet what I used on the chat box. It can be downloaded. I'll further again mail it to you as well.
Very good, very good, very good.
Thanks.
Thank you so much. Yeah.
So, sir, I'll take your leave, sir. Thank you, sir. Thank you.
Thank you, Rajesh. Thank you.
Thank you, sir. Thank you, Dr. Shiba. Thank you.
Thank you. Thank you.
Thank you, sir.
Yeah, just wanted to know the other participants. Your e-certificate will be issued upon completion of the feedback form, which is on the chat. It will be it is shared already on the chat box, so please answer that. Please fill up that, and then we will. After which we will be issuing your e-certificates. Just wanted to thank you. Brief. I'm going to just take a minute or two. I'd like to thank the management of MQI College of Management, Dr. Prabhudev, the director. Our two speakers, Dr. Lalita Ramesh and Dr. Rajesh Kumar, for all your
Dr. Lata Ramesh.
Dr. Lata Ramesh for all your valuable insights and most importantly the staff and the coordinators. We are probably out being viewed on the screen, but there are a lot of them who work backstage and have put this together. There's the staff, the faculty, everybody put together. I want to just thank you because I think they're not here. They are there. I know they're actually holding the fort for this entire session. Just wanted to thank each one of you. A big thank you to all of you participants for making this FDP possible. Your response has been gratifying, and to all of us, faculty, students, and the management of MCI College of Management who worked backstage. Signing off to Dr. Shiba Thomas for MCM College of Management.
The feedback form?
Yeah.
You need to be...
Yeah, you need to fill up the feedback form, and only then, once you leave the session, we'll know that you filled up the feedback form.
The link to the feedback form has been provided in the chat box. I request all the participants to kindly fill the feedback form, and then you can exit the meeting.
Thank you. Thank you, Dr. Shiba.
Thank you.
Thank you, Professor Samath.
Thank you.
Thank you.
The meeting will be kept open for another 5 minutes so that the chat box can be accessed by all the participants. The link to the feedback is available in the chat box. I request all the participants to kindly fill the form, and after filling, they can leave the meeting.